Nobody saw it coming. May 3rd, 2025, Berkshire Hathaway's annual meeting in Omaha. 40,000 investors packed into the arena, expecting the usual 5-hour marathon of questions and Warren Buffett dropping wisdom like he always does. They got that, but they also got something else. In the final minutes, the 94-year-old billionaire casually mentioned he's stepping down. End of the year. Done. Abel takes over January 1st. Most of the board didn't even know it was happening. Only his kids were in the loop. The room went silent, then erupted in applause. But here's what the headlines buried while everyone obsessed over succession drama. Buffett's been quietly dumping his best investments for 2 years straight, sitting on a mountain of cash bigger than most countries' economy, and sending signals that something's seriously wrong with where markets are headed. And the strategy everyone thinks made him $160 billion? Complete myth. The real story is way darker and way more interesting. Let's talk about what Buffett's actually been doing, because this is where it gets wild. Between late 2023 and mid-2025, he sold over 600 million shares of Apple. 600 million. That's not a trim, that's an exit. Apple used to be almost half of Berkshire's entire stock portfolio. The crown jewel, the business he called better than Coca-Cola and American Express. Now it's down to a quarter of the portfolio. He cut it by 69%, and Apple wasn't alone. Bank of America, another longtime core holding, he dumped over 40% of that too. 400 million shares gone. Meanwhile, Berkshire's cash pile hit $347 billion in the first quarter of 2025. $347 billion. That's enough to buy 95% of every company in the S&P 500. That's more than the GDP of Finland, Portugal, and 100 other countries. That's more treasury bills than the Federal Reserve holds. So the question isn't whether Buffett worried. The question is, what does he know that nobody else does? Because here's the thing most people completely misunderstand about how Buffett actually got rich. They think it's all about patience. Buy quality companies, hold forever, let compounding work its magic. Ignore the noise, stay invested. And sure, that's part of it, but that's not what made him wealthy. The real secret is concentration. Buffett doesn't diversify like your financial advisor tells you to. He does the exact opposite. Right now, over 50% of Berkshire's entire $300 billion stock portfolio is in just 3 companies: Apple, American Express, Bank of America. 3 stocks, half the money. That's not diversification, that's conviction. And when you're right about those 3 bets, that conviction prints money faster than anything else. Everyone loves the Coca-Cola story. He bought it in 1988 for about $1 billion. 37 years later, it's worth $25 billion, and it pays Berkshire $700 million a year in dividends alone. $700 million annually just from holding. That's almost as much as the entire original investment, just in yearly dividend checks. But here's what people miss about that story. Buffett didn't spread that billion across 100 different stocks. He bet big on one idea, held it through every market crash, every recession, every moment everyone told him to diversify, and he let it compound. That concentration is what made him rich. The patience just let the math work. But something fundamentally shifted in 2024. His shareholder letter that came out in February had a completely different tone. Warnings about fiscal instability, concerns about inflation eroding purchasing power. He's telling everyday investors to stop trying to pick individual stocks and just buy S&P 500 index funds. That's coming from the guy who built his entire fortune picking individual stocks. It's like Michael Jordan telling kids not to play basketball. Why would he say that? Some people think it's because he knows most people don't have the discipline. They panic during crashes. They trade constantly. They destroy their returns chasing whatever's hot on social media. But others think it's simpler and scarier. He's seeing valuations that terrify him. Markets stretch to levels that make no sense. Prices completely disconnected from underlying business fundamentals. That record cash pile isn't there because Buffett suddenly loves treasury bills yielding 4%. It's there because after 80 years of doing this, after surviving every crash since the Great Depression, he can't find anything worth buying. And if the greatest investor who ever lived can't find opportunities, What does that tell you about where we are right now? The succession adds another layer to this story. Greg Abel's been at Berkshire for 25 years. He runs the energy division. He knows balance sheets inside and out. Buffett's been praising him for years, calling him capable, hardworking, smarter than people realize. At the May meeting, Buffett said something that stopped everyone cold. He told shareholders that Berkshire will do better under Greg than it did under him. Think about that statement for a second. The man who turned a failing textile mill into a trillion-dollar empire just said his replacement will outperform him. Either that's the most humble thing anyone's ever said, or Buffett knows what's coming next, and he's relieved he won't be the one dealing with it. Abel's more hands-on, according to Buffett, works harder, but he's also inheriting a company with more cash than problems, a massively concentrated portfolio at what might be the peak of the longest bull market in history, and a retiring boss who's been selling everything for 2 years. No pressure whatsoever. The Apple situation is what really confuses everyone. At the May shareholder meeting, Buffett said Apple was an even better business than American Express and Coca-Cola. He said it would likely remain Berkshire's largest holding for years to come. Said he loved the ecosystem, the brand loyalty, the recurring revenue from services. Then he turned around and dumped more than half of it. Why? The official explanation is taxes. He's locking in capital gains at current rates before they potentially go higher. That makes sense on paper. Berkshire made a fortune on Apple. Taking profits to avoid higher future taxes is smart, but analysts think there's way more to it. Apple's valuation exploded. When Buffett first bought it back in 2016, it traded at 10 to 12 times earnings. Now it's at 36 times. For a value investor whose entire philosophy is buying things cheap and holding until they're expensive, that's uncomfortable territory. Plus, there are reports suggesting Greg Abel plans to keep trimming the position after taking over. The portfolio he's inheriting is dangerously concentrated. Over half in 3 stocks. If something goes wrong with any of them, Berkshire's in trouble. Abel needs to rebalance. Buffett could do that himself, but maybe he's leaving the hard decisions to his successor, passing the buck before he passes the reins. Either way, the signal is crystal clear. Even your best holdings can get too expensive to justify keeping. So what does all this mean if you're trying to build wealth? First thing, understand that the Buffett story you've heard your entire life is incomplete at best and misleading at worst. The myth goes like this. Buy great companies when you find them, hold them forever, ignore market noise, let compounding work. Wealth comes from patience. That's what everyone says. But the reality is different and way more nuanced. The reality is buy when things are cheap. Bet big on your absolute best ideas, not a little bit on 50 mediocre ones. Hold as long as the fundamentals stay strong and the price stays reasonable. But when valuations get stupid, or when the underlying business changes, or when you find something better, you adjust, you sell, you move on. Buffett's adjusting right now, massively. That should matter to anyone paying attention. Second, the psychological part of this strategy is absolutely brutal. Everyone thinks they can handle volatility until their portfolio drops 30 or 40% in 3 months. When Apple crashed in March 2020 during COVID, Buffett held, didn't sell a single share. When it recovered and doubled, he made a fortune. Most people can't. They panic. They sell at the bottom. They miss the recovery. Then they blame the market or their luck or anything except their own lack of discipline. That's why 90% of people fail at Buffett's strategy. Not because they pick bad stocks. Because they can't stomach the emotional roller coaster that comes with concentrated positions. And finally, time horizon. This is the part nobody wants to hear. Buffett's been investing for 80 years. 80, not 8, not 18, 80 years of compounding. His Coca-Cola investment took 37 years to turn into the monster winner it is today. You willing to wait that long? Because that's what compounding requires. Decades of doing nothing except holding and reinvesting dividends. Most people can't think past next quarter, let alone next decade. They want to get rich quick. They want the shortcut. They want the hack. And that's exactly why they stay poor. Because there is no shortcut. There is no hack. There's just time and discipline and letting math do the heavy lifting. Buffett understood that at age 11 when he bought his first stock. Most people never understand it at all. Here's the part that's going to make people uncomfortable. Warren Buffett is completely and totally irreplaceable. Not because Greg Abel isn't smart, he probably is. Not because Abel can't run Berkshire well, he probably can. But because Buffett isn't just an investor, he's a myth, a legend, an icon of American capitalism. The kid who survived the Great Depression, bought his first stock at 11 years old, and turned a failing textile company into the fifth most valuable company on earth. His annual letters are taught at Harvard Business School. His quotes are on motivational Instagram posts. He gave away more than $60 billion to charity and still has $160 billion left. You can't replace that with good management and smart capital allocation. Well, Abel will do fine, maybe even great. But when people ask in 10 years who the next Warren Buffett is, the answer will be the same as it's always been. Nobody. There will never be another one. And maybe that's the real lesson here. Stop trying to be Buffett. Stop looking for the next Buffett. Take the principles that actually work, adapt them to your own situation and time horizon, and build wealth slowly over decades. The boring way. The way that actually works, but that nobody wants to hear about because it's not sexy or exciting. Because at the core of everything, Buffett's genius wasn't stock picking. It was understanding human psychology and having the emotional fortitude to act rationally when everyone else panicked. When the market crashed in 2008 and banks were collapsing and everyone thought the world was ending, Buffett invested $5 billion in Bank of America. While everyone else ran screaming for the exits, he bought. When COVID hit in March 2020 and the market fell 30% in 3 weeks, he held everything. Didn't panic, didn't sell. Just wait. That psychological edge, that ability to ignore the noise and stick to a plan when your brain is screaming at you to do something, that's what made him wealthy. Not perfect timing, not brilliant analysis, discipline. And in about 30 days, when he officially steps down after 60 years, that's what people will remember. Not the billions, the wisdom, the discipline, the ability to be rational when the world loses its mind. So here's what you should actually do with all this information. Read. 1. Stop obsessing over individual stock picks unless you genuinely understand the business at a level most people never reach. Buffett himself is telling you to buy index funds. Listen to him. 2. Ignore short-term market moves completely. He said in his shareholder letter that he hasn't gone a single period since March 1942 without having the majority of his wealth in U.S. equities. That's 83 years of staying invested through every crash, every bubble, every crisis, every time people said the market was done. 3. If you do pick stocks, understand what you own at a fundamental level. Why does this business make money? What protects it from competition? Will it still be dominant in 10 years? If you can't answer those questions with confidence, you're not investing, you're gambling. 4. Concentrate when you find quality, but know the difference between concentration and recklessness. Buffett concentrated in businesses he spent years studying and understood better than anyone. Most people concentrate in whatever meme stock they heard about yesterday. Massive difference. And 5. Prepare yourself for the boring reality that building real wealth takes decades. It's not fast, it's not exciting, it doesn't make for good social media content, but it works. The era of Warren Buffett officially ends December 31st, 2025. 60 years of unmatched returns. 60 years of shareholder letters that taught millions how to think about money differently. 60 years of proving you don't need to be the smartest person in the room. You just need to be rational when everyone else isn't. Greg Abel takes over January 1st, 2026, inheriting a company worth over $1 trillion and sitting on $347 billion in cash, with a track record that will never, ever be matched by anyone. The real test begins then. Can Abel preserve the culture Buffett built? Can he deploy that massive cash pile wisely when opportunities finally show up? Can he resist the temptation to make splashy acquisitions just to prove he's not Buffett's shadow? We'll find out over the next decade. But one thing is absolutely certain. When you turn on CNBC in 2035 or 2040 and hear about Berkshire Hathaway, you'll still think of Warren Buffett first. Because legends don't retire, they just stop showing up to work. The wisdom lives forever. And maybe if we're lucky and we actually pay attention, a few of us will learn something from it before it's too late. The cash pile tells the story. The selling tells the story. The warnings tell the story. Whether anyone's listening is a different question entirely.